The Tesla stock has really been on an amazing run since it was announced that it will be added to the S&P 500 after posting some strong financial performances this year and becoming profitable for the first 5 quarters straight. That announcement more than tripled the tech giant stock and shot up its value to over $650 billion. Since then, the stock has witnessed a consistent rise and is now hovering around $660 a share. But how high can it go? Will it tumble back to earth after hitting dizzying heights, or are its fundamentals strong enough to sustain its strong run? Stay tuned to find out. On the 21st of December, Tesla was added to the S&P 500, a group of 500 best-performing companies in the US. To qualify for this privileged and exclusive group, a company must post profits for at least 4 quarters and must have a market capitalization of over $9.8 billion, must be highly liquid, and the company must have a public float of at least 10% of its shares outstanding. All of these requirements were not only fulfilled by Tesla, but it did it in style. At the time of the announcement to add Tesla to the S&P 500, its market capitalization was over $500 billion, that is over 5,000% of the $9.8 billion required. Tesla recorded $16 million as a profit for the first quarter of this year. This was the first time the company had recorded profitability in the first quarter of any year, and it was despite the fact that the factory in Shanghai was shut down in February, and in the US, it was also shut down at the end of March, all due to the deadly coronavirus pandemic. The company recorded a revenue of $5.99 billion, with $5.1 billion coming from the sale of cars and accessories. It also recorded earnings per share of $1.94 and a gross margin of over 25%. In the same quarter, the company's revenue from the sale of solar energy products was around $324 million, which was way below expectations. The company in the second quarter raked in a profit of $104 million, making it the 4th consecutive quarter in which the company recorded a profit. This was after recording $143 million as profit for the third quarter of 2019 and $105 million for the quarter 4 of 2019. The financial reports of the tech giant also indicated that it had recorded a positive free cash flow of over $400 million for the second quarter of 2020. The reports also showed Tesla brought in over $8 billion in cash and cash equivalents for the same quarter. Thus, the company had qualified to join the S&P 500. And since that announcement was made, the company's value and stock have skyrocketed to unprecedented levels. One of the main reasons Tesla is able to achieve its massive growth is its flagship product, electric cars. Generally, since the fourth quarter of 2015, the company has seen the number of cars delivered increase steadily. For example, the number of cars delivered in the first quarter of this year was a little over 88,000. By the second quarter, with the pandemic in full swing, Tesla delivered around 90,650 cars. The number of car units delivered worldwide in the third quarter rose sharply to around 139,300. Thus, Tesla is growing rapidly. However, let's compare its growth to other companies that have experienced similar exponential growth and see whether we can predict how high Tesla can really grow. Comparing Tesla to Apple. Let's begin with Apple. When the company went public in 1980, it was selling its shares at $22 a share. At the IPO, it sold approximately 46 million shares. According to available records, the dollar had an average inflation rate of 2.92% from 1980 till now. Therefore, $22 of 1980 will be equivalent to roughly $69.4. Tesla, on the other hand, IPO'd in 2010 at $17 a share, which is equivalent to today's $20. Thus, Apple had a more promising beginning, if I should say that. However, Apple started making giant waves in the stock market when it began producing the iPod. Just like there were electric car manufacturers before Tesla, there were other music players before the iPod. But the iPod became more popular. Why? It was due to its sleek design and its scroll wheel that could easily scan through thousands of songs in a minute. In February 2005, Apple did a 2-to-1 stock split for the third time. The iPod, just like the Tesla Model S, captured the fortunes of Apple, and by 2006, the company transformed from a computer manufacturer to a consumer electronics designer, with a stock price of over $70. The iPod was met with a lot of skepticism, with some calling it lame. The launch of the iPhone in 2007 revolutionized the cellular industry. The introduction of the iPhone shot up Apple's stock to over $198 that same year. The stock price, however, fell the following year to around $85. Apple's stocks then began an upward climb, but fell again by the end of 2010. It was selling at slightly over $46 per share. The regular introductions of the new and improved products such as the iPad and the Apple Watch led to Apple becoming a leading name in the world of tech. and by 2015, the stock was trading at around $133 after 2014's 7-to-1 stock split. After 2015, the stocks took a tumble, falling to around $22 per share within the year. 2016 witnessed the same story, as the price of the company's stock fluctuated between $22 to $30 a share. 2017 witnessed an upward climb in the price of its stock with an average stock price of around $37 and a value of around $750 million, which was way higher than the second most valuable company in the US, Google, which had a value of $590 billion. This rise was backed by strong financial performance and great products just like Tesla. That was when most analysis and the media started predicting that Apple will soon hit $1 trillion, and in just under 2 years, Apple became a $2 trillion company. Comparing Amazon to Tesla. Another company that had humble beginnings but has since grown dramatically despite all criticisms is Amazon. Founded in 1994 by Jeff Bezos, Amazon started as an online bookstore and is today one of the largest e-commerce stores with a value of over $1 trillion. Legend has it though that Amazon began as a bookstore. Jeff Bezos, just like Elon Musk, had a bigger vision of eventually turning it into the store it is today. Amazon, which was named after the largest river in the world, sold books to people in almost every state in the first months of its operation. The company went public in May 1997, with the stock selling at $18 per share. That will be around today's $29.16, when adjusted for inflation. Amazon has split its stock 3 times, once in 1998, once in 1998, and twice in 1999. Since its IPO, the company's stock has witnessed a meteoric rise, though it has had its fair share of topsy-turvy days. In 1998, the company's shares sold at an average of $15, going as high as $53 and as low as $4.95 a share. In 1999, Apple's stock opened the year at approximately $59 per share. The average stock price for the year was around $69, recording a year high of over $106 and a year low of around $42, closing the year at $76.13 a share. Amazon's stock price performed well due to the dot-com bubble during the late 90s. Just like today's mad rush for everything electric vehicle by investors, so many investors rushed to purchase the stocks of companies operating on the internet. However, due to the dot-com crash that occurred from 2001 to 2002, Amazon's stock was severely affected, losing more than 90% of its stock price during that period. Investors were forced to sell the shares, but founder Jeff Bezos never gave up. In 2003, Amazon's stock began to gain momentum. This was not necessarily due to the products Amazon sold, but their innovative accounting principles. Amazon used what is known in accounting as cash conversion cycle to grow its business after the dot-com debacle. The cash conversion cycle is the measure of how quickly you can get paid for a product you sell. This principle, adopted by Amazon, aided its stocks to recover. It opened the year at over $19 per share and rose consistently and steadily throughout the entire year, closing it at over $52 with an average stock price of roughly $38 per share. Amazon's stock steadily rose through the years till it crossed the $100 mark by 2010. At the beginning of 2010, the shares were going for $133.9. It recorded a year high of $184 per share and a year low of roughly $108.6 per share, closing the year at $180 per share. These stocks rose in leaps and bounds over the next 7 years, till they hit an average price of $968 by mid-2017. However, before the year had come to an end, the stock price had crossed the $1,000 mark, closing the year at over $1,169. Amazon reached its $1 trillion market cap for the first time in 2018, with its shares hitting a year high of $2,039, but closed the year at a little over $1,500 per share. Last year, the stock price had an average stock price of over $1,760, rising to over $2,000 and falling to around $1,500. This year has witnessed an incredible rise in Apple's stock and is currently hovering at around $3,172 per share, with a market cap of approximately $1.59 trillion. So, comparing how these companies are to Tesla, you can see easily that they have similar stories. But is that enough to guarantee that Tesla will be able to rise to reach that level, or may fall soon? Your guess is as good as mine. Hello everyone, and welcome back to Toasty Business. Today we're going to be doing an in-depth look at one of the most talked about rivalries in the world of business. A rivalry involving two giant CEOs who are the world's richest and second richest men, Jeff Bezos and Elon Musk. Over the last 15 years, both men have maintained an intense rivalry that was silent at some point before it boiled over into public knowledge over time. The major theatre for this rivalry was the space projects of both men. But to the surprise of everyone, both millionaires took their rivalry far beyond the confines of space aviation. Make sure you stay until the end of the video so you can know exactly what Jeff Bezos' plans are and how he is trying to crush not only SpaceX, but also Tesla. A historical review. Bezos and Musk were not rivals in the beginning. In fact, both men were not as successful and as recognizable as they are today. Back in the day, they were still pushing their way towards the upper echelons of power on Wall Street. Musk was the first to land big cash before Jeff Bezos did. This happened when he sold his firm PayPal for $1.5 billion. PayPal was a company he formed alongside his partner, Peter Thiel. The sale of PayPal earned Elon Musk a $165 million payout. As for Bezos, his company, Amazon, was beginning to show promise, but the official launch of Amazon Prime was still far off. However, he was already making significant moves that eventually succeeded and turned him into the man he is today. The richest man in the world and the CEO of the publicly traded company, Amazon, with a market capitalization of over $1.5 trillion. How then did the rivalry start? They apparently fell out after a dinner. First of all, we need to let you know that no one knows for sure or with a certainty of proof when this rivalry started. The best people to make the conclusion is Jeff Bezos and Elon Musk, but to suffice to say, the dinner they had was probably the turning point in their relationship and the beginning of that rivalry that we witness today. Sometime in 2004, before SpaceX and Blue Origin had ever completed any official project launches into space, both men met for dinner to discuss the possibility and potential of reusable rockets. According to author Christian Davenport's book, The Space Baron, the meeting didn't end well. Being the more experienced of the two when it came to space technology, Elon was quoted as saying he tried to give Jeff Bezos advice, which he largely ignored. This apparently kickstarted their rivalry. From this period onward, they began to feud with each other. But how do we know that this rivalry is not mere speculation? How do we know that the story of the first and second richest men on Earth feuding with each other is not just paper talk? Well, here are some facts to prove the credibility of the story. Elon Musk mocked Blue Origin's lack of innovation. After 10 years of operation, Blue Origin had still not been able to create a spacecraft that could make suborbital flights to space and back. Due to their slow progression, Elon suggested that Blue Origin might not be able to achieve the feat after all. The best commendation that he could give Blue Origin was the possibility of their craft getting NASA's certification for human safety standards in the next 5 years. The SpaceX founder was quoted as saying, "Frankly, I think we are more likely to discover unicorns dancing in the flame duct." A subtle jibe at Blue Origin's inability to achieve any noteworthy feat. SpaceX wins patent battle. In 2014, both men alongside their companies were involved in a feisty legal battle over a patent right. Blue Origin won a patent for ship designs for landing space rocket boosters. SpaceX countered this move by launching a petition to invalidate the patent right issued to Blue Origin. SpaceX argued that the rocket's landing booster design was, in their own words, an old hat, already used by many other firms in the industry including SpaceX. But given Blue Origin's patent rights over the design, that meant that SpaceX would have to pay Blue Origin a patent fee each time they used it. When the case got to court, the presiding judge ruled in SpaceX's favor. After the ruling, Blue Origin had to relinquish all rights to the designs. Twitter spat. Here is another piece of evidence that both men have been going at it for years. This time, it involved a public spat on Twitter. After Blue Origin successfully landed its rocket, Bezos boasted about it on Twitter, calling it the rarest of beast, a used rocket, in an attempt to trumpet Blue Origin's achievements. Well, the boast didn't go down too well, with Elon Musk who fired back with his own Twitter account saying, and I quote, "SpaceX has performed this feat 3 years prior," calling out Bezos for trumpeting an achievement that was old news already achieved by SpaceX. In light of the back and forth jibes from both businessmen, how has Jeff Bezos responded? With fury, in both cash and kind. In this next part, we'll chronicle the moves the Amazon billionaire has made to upstage Elon Musk's projects. Moves Jeff Bezos has made to crush Tesla. Invest in competitors. Jeff Bezos did not end up the richest man on Earth by being unintelligent. Making smart business moves and a dose of luck propelled him to the top of the rich list. To outsmart his Tesla rival, Bezos started to invest in rival startup companies involved in the same line of work as Tesla. Why such a pragmatic move? Well, first of all, Bezos knew that he was far behind the experience scale when it comes to technology. He also knew that starting from scratch will cost him a lot of valuable time and resources. To even the odds, he began to acquire space tech firms. One of his first moves was to help a space startup, Aurora, secure about $530 million in funding on February 7, 2019. His second move was to invest in an automaker by the name of Rivian. How much Bezos invested into Rivian is still not known, but in a shocking move that called his decision-making into question, he placed an order of 100,000 delivery vehicles by the automaker to be delivered by 2024. Now, this decision was questioned by observers because Rivian technology lags way behind that of Tesla. Having to spend such a fortune on inferior trucks did not look like a smart business move, but Jeff Bezos did it anyway. The Climate Pledge. Another plan hatched by the Amazon CEO was to grow his company portfolio by filling it with companies and startups already competing with companies owned by Elon Musk. To achieve this plan, he unveiled his venture capital firm, the Climate Pledge. The sole investment focus of the Climate Pledge is to invest in three key areas: transport and logistics, energy generalization, storage and utilization. The launch of the Climate Pledge raised more than a few eyebrows. But why was that? Simply because these three key areas represent the core focus of Tesla. Beyond that, when you look at the mission statement of Bezos' investment firm, it appears to have the same plan as Musk's Tesla, which also focuses on achieving sustainable energy and reducing carbon emissions. Why Jeff Bezos would follow the same path as Elon Musk is open to different interpretations, but many saw this move as the willingness of the Amazon CEO to compete on the same turf with Elon. The acquisition of Zoox. Jeff Bezos acquired a self-driving autonomous vehicle manufacturer called Zoox. Acquiring a new portfolio should not raise too much dust, should it? Well, not if the company in question was caught and fined for stealing from none other than Tesla. Zoox is an electric car manufacturer. Manufacturing electric vehicles with the same futuristic designs is synonymous with Tesla cars. The same company was adjudged to have stolen designs from Tesla, and the litigation that followed affected their stock prices as they lost public trust. With their share price down, guess who came to the rescue? Elon Musk's nemesis, Jeff Bezos. Bezos bought Zoox shares at rock-bottom prices and invested a lot of money into it to make it solvent again. The word on the street is that he plans to either compete with Tesla by selling Zoox cars to members of the public, or to make Zoox the main suppliers of Amazon's delivery vans. A ride-sharing network. Ride-sharing platforms have been around for a while, but Jeff Bezos has no plans arriving late to the party. He has set plans in motion to launch his own ride-sharing platform to compete with the likes of Uber, Tesla, and Lyft. This move is another in a long list of moves made by Jeff Bezos to bulk up his anti-Tesla portfolio. The future. Despite their boardroom rivalry, Musk and Bezos have continued to grow their wealth in ways that we've never seen before. SpaceX launched 2 NASA astronauts to space this year and has partnered with NASA to send 4 more astronauts to space in the coming months. As for Tesla stocks, they hit an all-time high despite the economic strain brought on by the pandemic. Tesla's market value is now close to $500 billion, and Musk surpassed Mark Zuckerberg and Bill Gates to become the second richest man alive, with a personal fortune of $128 billion. Jeff Bezos has done well for himself during the same period. He extended his standing at the top of the rich list with a personal fortune of $182 billion. Amazon stocks are also worth about $1.5 trillion as of the time of making this video. Bezos has been able to amass all this wealth in a COVID-hit economy while also facing government scrutiny for Amazon's monopolistic practices. Who do you think will come out on top in the battle for supremacy between both? So there's been a lot of craze, or should I say, excitement rather, about EVs in the past decade thanks in part to Elon Musk. The excitement grew to dizzying heights getting to the end of this year, as more and more people are subscribing to the stocks of electric vehicles. But is all this excitement justified? Or are electric vehicle stocks, like the 2008 housing market bubble, ready to burst? Let's find out. The world is gradually warming up to electric vehicles. What was a dream some years ago is now a reality. According to reports, electric vehicles, both battery electric and plug-in electric vehicles, have crossed the 2 million sales mark and are still climbing. The IEA has also estimated that sales of EV will account for about 3% of the total of cars sold for 2020, which is an improvement on last year's 2.6%. Records also indicate that from January to September of this year, registration for pure electronic vehicles has gone up by 127%, which is a new record compared to the whole of 2019. In the UK alone, it has been reported that over 164 pure electric vehicles are plying their roads, and over 370,000 plug-in and plug-in hybrids are being used on a daily basis. In the US alone, roughly 1.4 million plug-in electric cars have been sold since they were first introduced in 2010. The Tesla Model 3 is the most purchased, with 154 units sold, followed by the Toyota Prius. Currently, Tesla is the world's most valuable car company, and that says a lot about the current state of the EV industry and the consumer's growing appetite for electric vehicles. Some experts have even predicted that within the next 10 years, the world's most valuable company will be a car manufacturing company. And from where I sit, electric vehicle companies are not far from achieving this status. In recent times, Tesla's market cap has gone up by roughly $500 billion, and it is as valuable as the 9 largest car companies in the world. Chinese EV companies NIO, XPeng, and Li have a combined value of $138 billion. NIO, as we speak, is even more valuable than General Motors. Speaking of which, the Chinese market has been a great place for EV vehicles. For over 5 years now, it has been a leader in the sales of plug-in electric vehicles, selling over 1 million plug-in electric passenger cars. First, it sold 207,000 in 2015, 579 in 2017, and roughly 1 million in both 2018 and 2019. I brought up all these stats because I want to show you, gradually, electric vehicles are taking over the automotive industry, not just in the US but globally. This is good for the climate as electric vehicles are fuel efficient and don't pollute the environment as their competitors do. Though some electric vehicles are pretty expensive, they are easier to maintain and handle. Analyzing the XPeng stock. Their stocks are also doing well. XPeng, NIO's rival in the Chinese EV market, went public on the 21st of August of this year under the ticker symbol XPEV. The target was to sell roughly 85 billion shares in the price range of $11 to $13 per share. However, they ended up beating expectations by selling almost 1 billion shares for $15 a share. The Guangzhou-based company raised a total of $1.5 billion from the IPO, beating its $1 billion target. This was because of the strong demand for the stock at its IPO. The stock opened on August 27th at $23 per share, over a 150% increase from its IPO price. By the 5th of November, XPeng stock had risen to about $30 a share, closing the same day at $35 a share. The company's stock price kept skyrocketing till it hit the highest price of $65 a share during the intraday trade of November 27th. The strong performance was due to favorable analysis from experts, strong and impressive third-quarter results which boosted investors' confidence, and the delivery of over 3,000 vehicles, representing an increase of 229% year-over-year. However, its stock price came tumbling down right after that dizzying height, falling to $47 a share by December 2nd, losing over 60% of its stock price. This was because the whole EV market was pulled down by 2 developments. First was the disappointing report that Nikola had lost its deal with General Motors to build their Badger pickup, and the second reason was because of the damning report by Hindenburg Research on Kandi Technologies, another Chinese electric vehicle maker, which was accused of falsifying its revenue, painting a false picture to its investors. This made investors lose confidence in the EV market as a whole and began selling their stocks. So, it wasn't as if XPeng's fall from grace was a result of its own doing. However, do note that XPeng isn't profitable yet. It posted operating losses of over $500 million last year, and the first half of this year has witnessed the company lose over $200 million. Its free cash flow was negative $172 million in the first half of this year, and a negative $504 million in 2019. Analyzing Li Auto stock. Li Auto, another EV company, debuted on the Nasdaq this year, precisely July 30th. Just like XPeng, Li Auto reportedly raised over $1 billion at its IPO, bringing the company's valuation to $10 billion. Its opening share price at the IPO was $15, and by the close of the day, it had risen to around $16 a share. It hovered between $16 and $20 per share until November 4th, where it hit the $25 per share mark. This was due to the strong demand for the company's crossover vehicle, the Li Shang 1. This demand boosted investors' confidence, thus, more shares of the stock were purchased. The reason for the mad rush for Li's stock was, in October, the company delivered over 3,000 cars, representing a 5.4% increase over what it delivered in September. The stock kept climbing steadily till it reached an all-time high of over $47 on November 24th. Then it began tumbling down due to the negative effects the EV market suffered as a result of the bad press around Kandi Technologies and Nikola. Li Auto is also losing money. Its third quarter net loss of $15.7 million was higher than its second quarter net loss by over 40%, meaning Li Auto is not as profitable, at least for now. Analyzing NIO stock. NIO's story is a little bit curious. Unlike XPeng and Li Auto, NIO didn't have a dramatic rise in stock price. It had a topsy-turvy time when it went public in September 2018. It debuted on the New York Stock Exchange at $6 per share, and then went on a downward trend till it hit about $1 per share. Then it began a road to recovery. NIO stock opened this year at $4.1 per share and fluctuated between $2 and $7 the first and second quarters of 2020. The third quarter saw the stock rise to roughly $12, and by the end of the quarter, NIO's stock price was hitting over $21 a share. What accounted for the phenomenal growth was not the doing of NIO itself, but its competitor XPeng. XPeng witnessed a strong third quarter, performing well beyond expectations. Thus, there was a great appetite for EV stocks, and that is how NIO benefited. Today, NIO stock is hovering around $46 with an estimated market cap of $73 billion. However, NIO has burned through $4 billion in cash in 3 years. It was only saved thanks to a bailout from the Chinese government. Analyzing Nikola. Nikola, an American EV company, has a somewhat gloomy tale to tell. Its stock started nicely by debuting on the Nasdaq at over $37 per share. By the middle of June this year, the company's stock had gone through the roof, recovering over $71 per share as its stock price. This surge in stock price came about as a result of a tweet made by the founder of the company, Trevor Milton. In this tweet, he noted that reservations for the company's zero-emission truck, the Badger, would kick off later that month. The tweet excited investors, and most of them started buying Nikola stocks. The stock, however, fluctuated between $64 and $74 per share for the entire month of June. The company's stock price started falling, and by the end of July, the company's stock had fallen to about $30 a share. This was due to some experts in financial analysis issuing a hold rating on the Nikola stock. But the real reason the stock dropped was that Nikola, on the 22nd of July, announced that it would begin allowing redemption of warrants. That announcement scared investors, and they began selling their shares. However, the real problem for Nikola started when a short seller, Hindenburg Research, put out a statement accusing the company and its CEO of deceiving the public. This led to the resignation of the CEO and his departure. Many investors in the automotive industry lost interest in the EV stocks, and as a result, the stock of Nikola plummeted. Today, its stock is around an all-time low of $17 a share. Analyzing Workhorse's stock. Workhorse, on the other hand, began the year with a $3 per share stock price. It slowly but steadily worked its way up, fluctuating between $1 to $3 a share in the first and second quarter of this year. In the first quarter, for instance, the company recorded sales of $84,000, which were way lower than the $364,000 reported for the same period last year. According to the company, the decrease in sales was primarily due to the decrease in volume of the trucks shipped. By June, the company's stock had risen to around $15 a share. The surge in stock price was due to the $70 million Workhorse secured in new financing. This served as a confidence boost for investors. The stock kept rising, and by September, the stock price of the company had hit $25 per share. However, it started falling the following months, recording a stock price of $15 per share by the end of October. This is because its financial report indicated a third quarter revenue of under $1 million, with the company losing $84 million due to delays in producing electric vehicles. Currently, the stock is around $21 per share. Workhorse is currently not profitable as it is struggling to meet expectations. Analysis had expected the company to make sales of over $200,000, but the company managed a meager $91,000. It also lost $7 million from operations, an increase of almost $3 million from last year. Analyzing Tesla's stock. Finally, let's take a look at Tesla's stock. I won't be talking about it too much because Tesla is a very popular stock at the moment, and the company's rise to become the global leader of the EV industry has been well documented. Tesla's stock opened the year at just around $84 per share. By February, it was trading around $134 per share, and by July, the stock had gone up to roughly $289 per share. Tesla split its stock 5-to-1 in August to enable investors with limited funds to afford the ever-rising stock. The following month saw the stock price rise to a little over $500, and today, the stock is trading at around $695 per share at the time of its inclusion in the S&P 500. My verdict. Now, taking into consideration the stock history of the major EV companies in the world, I dare say that we are in an EV bubble, given that NIO, Li Auto, Nikola, and Workhorse are not profitable at the moment. However, don't take my word for it, make sure you do your own research before you make any concrete decision. Thanks for watching. While you're here, go ahead and click on one of these two videos on your screen. See you there.